Most people hear SBA loan and think it means a small business loan for inventory or startup costs. But the SBA 7A program can be much bigger than that. In 2026, this is one of the most important financing tools for business owner who wants to buy a business, buy a building, buy equipment, or expand with working capital. The key is understanding that SBA 7A is not a real estate investment loan. It is business financing backed by SBA guidelines and lender underwriting. SBA 7A page lists several eligible use: acquiring, refinancing, or improving real estate and buildings, short and long-term working capital, refinancing current business debt, purchasing equipment, purchasing furniture, fixture, and supplies, and change of ownership. That is why a 7A loan can be useful when the deal is not just a building. For example, a buyer may be purchasing or rent a dental practice, the equipment, and the patient list, and the building. Or a buyer may be buying a franchise and also need working capital after closing. A regular commercial real estate loan may only care about the property. SBA 7A can potentially wrap multiple business purpose use into one single structure, subject to the SBA and lender rule. SBA says the maximum 7A loan amount is $5 million. The lender terms page also explain for most 7A loans, SBA guarantee up to 85% for a loan of $150,000 or less, and up to 75% for loans above $150,000. The guarantee does not mean the borrower is guarantee approval. It means SBA shares some of the risk with the lender if the loan follows SBA rules. The borrower still has to qualify. On term length, SBA lenders comparison materials explain that 7A loans are generally 10 years or less unless they finance or refinance real estate or equipment with a useful life over 10 years. And real estate can go up to 25 years, including extension. So a 7A loan used mostly for real estate may be structured differently from one used mainly for working capital or goodwill. The mistake borrowers make is assuming SBA approval works like a residential mortgage. It does not. SBA SOP 5010 is the loan origination policy manual for 7A and 504 loans. A lender will look at eligibility, use of proceeds, business cash flow, management experience, collateral, personal guarantees, equity injection business valuation, and whether the business can repay the debt. For example, if the business has $450,000 in annual cash flow and the new SBA payment is $300,000 per year, the lender may look at whether the debt service coverage is strong enough after the owner's salary, add backs, and require expense. The property value alone will not save a weak business. SBA 7A can be powerful because it is flexible, but that flexibility comes with a lot more underwriting. It is not for passive rental investing. It is for eligible operating business with a real business purpose and repayment ability. For the right owner, you can finance a business, a building, equipment, and working capital. For the wrong borrower, it can become a long underwriting process with no chance of approval. Now, if you own a business or want to buy one, look at the full project first. Business price, real estate equipment, working capital, cash flow, and equity injection.